Title: How to Value a Commercial Property, the Income Approach Explained. One of the biggest differences between commercial and residential real estate is how properties get valued. In residential, you look at what similar homes nearby sold for and work from there. In commercial real estate, that approach barely matters. Commercial properties are valued based on income. And once you understand how that works, you can look at any commercial deal and know almost immediately whether the price makes sense. Let me show you exactly how it's done. The method is called the income approach, and it's the dominant valuation method in commercial real estate. The idea is simple: a commercial property is worth whatever income it generates, discounted to what a buyer would pay today for that income stream. The formula you need: value equals NOI divided by cap rate. We've covered both of these before. NOI is net operating income, the money a property earns after expenses before debt. Cap rate is the market's required return for that type of property in that location. Let's walk through an actual valuation. You're looking at a 10,000 square foot office building. It has 3 tenants paying a combined $180,000 per year in rent. After applying a 5% vacancy factor, that drops to $171,000 in effective gross income. Operating expenses, taxes, insurance, management, maintenance total $60,000 per year. NOI equals $171,000 minus $60,000 equals $111,000. Now you need a cap rate. You pull up recent comparable sales in the market. Similar office buildings in that submarket have been trading at 6.5% cap rates. Value equals $111,000 divided by 0.065 equals approximately $1.7 million. That's your indication of value. If the seller is asking $2.2 million, the math doesn't work. The implied cap rate at that price is only 5%, below what the market is pricing that asset class. If they're asking $1.6 million, you're buying at a slight discount to market. This is exactly how brokers and investors underwrite deals. The asking price is almost secondary. What matters is whether the NOI and the cap rate support the number. Now there are two important nuances here. The first is stabilized versus in-place NOI. In-place NOI is what the property is actually earning right now, based on current leases and current occupancy. Stabilized NOI is what the property would earn at a normalized occupancy, usually 90 to 95%, with market rents. If a building is 70% leased today, its in-place NOI will be depressed. A buyer might still pay close to a stabilized value if they believe they can lease it up, but they're taking on leasing risk, and the price should reflect that. The second nuance is expense reimbursements. In some lease structures, particularly gross leases, the landlord pays all expenses and collects a flat rent. In NNN or modified gross leases, tenants reimburse the landlord for some or all expenses. This changes how you calculate NOI. If tenants are reimbursing $40,000 in expenses, that flows back as income. You have to be careful to model this correctly, especially when comparing properties with different lease structures. Here's something that trips people up: cap rates move inversely to value. If cap rates in a market compress from 7% to 6%, the same NOI is now worth significantly more. Take $100,000 NOI, at a 7% cap that's $1.43 million, at a 6% cap that's $1.67 million. A 1% move in cap rates changed the value by $240,000 on the same income. This is why cap rate movements matter so much to real estate investors. When interest rates rise, cap rates tend to follow and values fall. When capital floods into real estate, cap rates compress and values rise, even with no change in income. Here's the one sentence to remember: commercial properties are valued using the income approach. Divide NOI by the market cap rate to get value. The income is the asset, and cap rates are the market's price for that income. Subscribe and I'll see you in the next one.